Hello, everybody. Happy Wednesday, hump day. How is everybody doing today? Market's definitely, getting a little nervous here, a little bit in the red today with S&P's down about 50 points right now. Can everybody hear and see me okay? Let me know in the chat here, please. And looking forward to a real interesting conversation here today about dividends. Let me know here in the chat. Come on. There we go. Phew. Man, I thought that we were empty today. Let's get the word out, everybody. Good. So as I said, market S&P's down about 50 points right now. What's interesting though is overall volume is still really anemic. What do I mean by that? Where is the interest in the market? Well, let me show you some stats from yesterday, and you guys could all get these reports as well. But let me show you this from yesterday here. Okay, this is a report I get from the CBOE, and I have other ways that I get this info, but you can get this from the CBOE. You can also get it from the CME as well. But if you see this right here, this is yesterday, and this has been a trend here. You can see yesterday's option volume, 41 million contracts. Sounds like a lot of contracts, right? But 15% below recent averages. Okay, what I do really like about getting this report every day from the CBOE, and if you guys want to get it, I'll show you how to register for that. It breaks everything down here that you may want to see on a very macro level. So CBOE products first, you can see SPX data, VIX data, XSP, then those comp ETFs. So SPY compared to SPX, IWM compared to Russell, Qs, so on and so forth. Okay. Then it shows you most active stocks and option volume there, which I like a lot. Most active ETFs, most active index products. Okay. Big, large block volume, and then gives a little recap of earnings. And they put this out every single day. And I just think that it is a really, really useful, handy tool to just kind of get a snapshot of what's going on in the marketplace. So I would highly recommend if anybody wants to get that data, that's a really, really good place to start. Okay. Earnings. What's going on with earnings? Tesla, the big one after the close today. We have some positions on in some other companies with earnings after the close today. We've got IBM, IBM, which is after the close today. We have FedEx, which they don't have earnings, but we have a position on based on UPS earnings, which are tomorrow morning. So we've got that going on. We're trying to get into, we have a signal out there right now for Google. Now, Google, Alphabet, they have earnings next week. What I'm looking at here is this right here, this convergence of the 50 and the 200-day moving average right there as some support. Now, I don't know what earnings are going to be, but what I'm looking at is to potentially get a little bump off of that heading into earnings. So we're just looking for anticipation of a little bit of a stock moving higher before earnings. So that's the goal kind of behind that. And everything else is kind of status quo here. So I want to get into dividends. Okay, first off, how many of you understand what a dividend is and how it affects a stock price. Okay, what happens to a stock price when a company has a dividend? Man, we're still getting all the me's in here for the wheel. One of these days, we're going to give you a surprise, and maybe I won't even do the wheel. And you're going to have all the all this build up and get my name registered in there. But okay, good, John. Right. Think about this, everybody. Think about this. When a company pays a dividend, okay, what happens to the value of that stock? The value of that stock goes down, right? Because what they're doing is taking cash and giving it to their shareholders. So the stock goes down. Okay? Now, in order to receive a dividend, you must be a stockholder. Okay? A call position, if you have just a call, you will not receive a dividend. Same with a put, but puts don't really make a difference there. You actually have to be a holder of the stock. Okay? So if we know for certain that a stock is going down, okay, what will happen to the value of call options? What will happen to the value of put options? Okay, so if we know that a stock is going down, the value of calls are going to go down, and the value of puts are going to go up. Does that make sense? Does that make sense to everybody? Calls lower, puts up, Tom's. Okay, great. So if we know that for certain, right? Not just that we're looking at charts and a stock may look bullish or bearish, but if we know that for certain, then the option prices must reflect that. Okay, they must already reflect that. Well, Stephen, you ask why. If a stock goes down, okay, if a stock goes down, what happens to the value of a call option? And if a stock goes down, what happens to the value of a put option? Okay, let's take a look at an example. There's a few stocks that have some pretty nice dividends that are coming up that we can absolutely take a look at here. Okay, so I want to look at that first, and then I also want to talk about some trading nuances that can happen with trading around a dividend. Exxon, XOM, this is a real good one because I want to look at the money options. Okay, Exxon, right now trading just about at 120. Okay, everybody see that up here? They pay a dividend of 95 cents. Okay, and the ex-dividend date. The ex-dividend date is the date that the stock reflects the dividend payment. Okay, the ex-dividend date is November 14th. Okay, right here it says November 14th, and they pay a 95-cent dividend. If we look at our at-the-money options, okay, where the stock is trading right now at 120, okay, we can see this week, boy, we've got our call and our put trading pretty much to the penny. Right? Does everybody see that? Hey there, Zora. Okay, remember that whole put-call parity conversation that we've had where the extrinsic value, the premium levels of calls and puts have to be the same? Okay, here we are. We're right at the money, and we've got those the same. If we go out next week, okay, and again, look at I'm going to blow this up here for everybody. If we go out next week and look at the 120 call and put, Does everybody see right at the money that call and put are trading basically the same? Put, call, parity. Okay, and let me know in the chat, guys, if you're following along and if you can see what I'm explaining and that it makes sense to you. Okay, great. Now, let's go to the following week. Let's go to November 8th. Okay, November 8th expiration here. Here is at the money. Okay, same thing. We've got that put call parity. Yeah, there's a little discrepancy because as we talked about, interest rates play into this. Okay, but we've got that put call parity. Now, the next expiration, which is November 15th, that is the one that's going to be affected by the dividend that they pay out on November 14th. So all of the options priced up to the date ahead of the dividend, in this case, November 14th, the dividend has no bearing on those options. Okay? But on November 14th, wherever the stock may be, where it closes on the 13th, let's say on November 13th, okay, obviously this is hypothetical. Let's say on November 13th, the stock closes at 120. Okay? On November 14th, the value of the stock, all else being equal, will be what? Okay, when the stock opens up on November 14th, all else being equal, what would that value of Exxon be? That's right. How many of you see that? How many of you understand that? Good. Thomas, John, Scott, exactly. Okay, the value of the stock would be 119.05 because we're removing 95 cents out of the worth of the company, 95 cents per share. So all of the options then that get affected by that dividend, okay, so those options would be November 15th expiration, have to look at the stock as if it will be priced 95 cents lower. Okay, so let's go back to our option chain here. Let's go back to November 15th. Remember, all of the options with an expiration prior to the dividend are not affected. Now, all of a sudden, look at our put call parity. All of a sudden, we can see this put price much more expensive than the call. Okay, so when I've discussed this in the past with people and I've asked them, why is that? The common answer, the most common answer is, well, the put price is more expensive because the put price is more in demand. People think the stock is going down, right? They're bearish. Well, there's only part of that answer that is actually accurate. Okay, the stock is going to go down, is going to be worth less because of the dividend. It has nothing to do, nothing at all to do with the fact that people want to buy puts more so than they want to buy calls. So that pricing is already factored in. Okay, does that make sense to everybody? Does that make sense? Okay, excellent. Let's look at another one. Let's go through one more example here and let's see, there were a few stocks I had noted to get ready for today. Let's check out CVX Chevron, see if that thing is trading still close to being at the money. It's moved away a little bit. Let's take a look at Phillips 66. Okay, that one's right at 129. Good, we can look at this one. Okay, PSX, Phillips 66. Dividend on November 18th for $1.15. Scott, can it be arbitraged? Yes and no. No, because the option market is already going to factor in the correct pricing. Possibly, which is something I'm going to show you shortly. Okay, but we can see here with Phillips 66 on November 18th, they pay a dividend of $1.15. All of the options leading up to that date will not be affected by the dividend. So going all the way through November 15th, none of those options will be affected. But if we look at the following expiration here, November 22nd, so that is after the dividend. Let's look at the 129 at the money here. And we've got the put price trading more than the call. Okay, if we go 1 week prior to that where the dividend is not a factor, so let's go back to the 15th at the money, the call is trading more than the put. Okay, let's look at one more. Let's see where IBM is right now because they have a pretty decent dividend as well. IBM 232.5. Good. We're right at a strike. We're right at a strike. So IBM pays pretty hefty dividend, $1.66 on November 8th. Okay, so this week's options are not going to be affected. And we can see the at the money call and put call parity trading the same. Move ahead to November 1st, the 232.5, basically trading the same. Okay, but then we move ahead to November. What day did we say the dividend was? The dividend was the 8th. So actually on expiration date. So on November 8th, what should we see here? Well, all of a sudden, that put is trading much more expensively than the call. Again, that's not because people are bearish in IBM. That's because they pay a dividend. So it must be factored in. Okay, now, Steve, you asked, can this be arbitraged at all? Okay. Back in the day, when I say back in the day, trading on the floor, we would trade what was called dividend plays all the time. All the time. What does that really mean? Okay. So remember what I said at the beginning of the conversation. If you own a call option, which gives you the right to buy stock, but if you own a call option, it does not allow you to collect the dividend. You must outright own the stock rather than the call option, which means if you want to collect a dividend and you own a call option, what would you have to do? What would you have to do? You would have to exercise your call option, right? Exercise it the day, but not covered calls, Gene. Covered calls, I'm not sure what that even means. We're talking about owning a call option. If you own a call and you want to collect a dividend, you have to exercise your call to turn it into stock. Okay? Otherwise, you don't get the opportunity to collect the dividend. So if you exercise your call option, okay, and we talk about this a lot when we get into a situation where we may have a short call option or a short put option that is in the money, and people get concerned about, oh boy, am I going to get assigned? What do we have to look at to determine if we are going to get assigned on an option that we are short early, ahead of expiration? What do we always talk about? Why would someone exercise their long option or not exercise their long option early? What would make that decision? Yeah, well, not in the money. Not in the money. There you go. Scott Schaefer is spot on. We always determine if someone would exercise early depending on the amount of premium, depending on the amount of extrinsic value. Right? If there's extrinsic value left in an option, typically someone's not going to exercise that option early because they lose that value. Okay? As Scott Schaefer just said, though, if I have an in-the-money call option and I want to collect a dividend, okay, I have to exercise that call option. Well, as Scott said, the amount that I am going to receive by exercising the call and then collecting that dividend, that should be or must be more than what the extrinsic value is that I'm giving up. So for instance here, and I know, this can be a little bit confusing. Let's go back to IBM here. Okay? Stock is 232 and a half. Okay? The dividend was, what was it, $1.15, I think? $1.66. My bad. Okay? The dividend is $1.66. Okay? So right now, how can we tell just by looking at the option chain if it were time for IBM to go ex-dividend? How could we tell which of these call options someone might exercise to collect the dividend? How could we tell if someone would exercise their 180 call? How could we tell that? Okay, how could we tell that? Market is falling like no bottom. Really? Hang on. What's going on here? S&Ps are down 67. I mean, I wouldn't necessarily say that it's falling like there's no bottom, but back to the dividend. How do we know which call options here, guys, someone would exercise to collect the dividend? Or let me ask you this. Would someone exercise the 220 strike call? If you were long, if you owned the 220 strike call, okay, would you exercise that to collect your dividend of $1.66? Anybody? Anybody? You would, Rodney? Okay. Anybody else? Would you exercise your 220 strike call to collect your dividend? Alan, that's a great answer. Okay. John, you say yes. Okay. What did we say we have to look at to determine whether a call should be exercised early in order to take the dividend, in order to collect the dividend? What do we have to compare? Remember what we said? Put this back up here, $1.66 dividend. Calculate the extrinsic value. Excellent, John. Excellent. Okay, how much extrinsic value is in that 220 call? Pretty easy. If we take 220 plus the price of the option, that's 235.75. The stock is trading 232.50. That means there is still $3.25 of premium, $3.25 of extrinsic value. Does everybody agree with that? Does everybody see that there is still $3.25 of time premium, theta, priced into that call option? Does everybody see that? Okay, well, if I exercise that call, I am giving up the right to all of that time premium. I'm giving away $3.25. If I'm giving away $3.25, I better be getting at least $3.25 back, but I'm only getting a dividend of $1.66 back. So that would be a terrible, terrible move. You would lose roughly $1.60 by exercising that call early in order to collect the dividend. So in this case, you would not want to exercise that call. What calls would you want to exercise? Well, you'd want to exercise calls the deeper and deeper and deeper in the money they are, meaning the less time premium, the less extrinsic value. So would I exercise the 200 call? I sure would. That would be about kind of the toss-up almost. If I take the 200 call, which is trading $33.45, okay, that's $233.45 less where the stock is trading, I'd be giving up $1.20 worth of time premium there. I would give up $1.20 if I'm getting $1.66. Does that make sense? No trick questions here, Francisco. I'm just trying to teach you. There are no trick questions. Does everybody see this, right? One side of the ledger, I'm giving up $1.20 here in premium, but the other side of the ledger, I'm getting $1.66. I'm 46 cents in the black on that. I would exercise that call. Okay, gotcha. All right, everybody good with that? So it is so important, guys, to understand the relationship. There we come into play again, that call put or put call parity that we talked about. where we know that the extrinsic value has to be the same. But if there's a dividend, it skews it and it's not the same. And there's a reason for it. It's not because the supply and demand, more people want the put than they want the call. It all has to do with what happens to the stock price and then ultimately what happens to the option prices when there's a dividend and that stock goes ex dividend. So Scott, I know we're running a little late and I'm fine with that. That's what I wanted to get into right now. Scott Schaefer just asked a great question. Do the market makers look for short calls to exercise to capture dividends? So what we used to do on the trading floor, and what still may happen for some of the big firms, and you will typically see this the day before the ex-dividend. So in the case of IBM, the dividend is on the 8th. So I'm going to make a reminder. I'm going to make a note to watch for this option activity on the 7th. What you may see happening are some very deep in the money call spreads trading. For instance, let's just say the November 140, 150 call spread. Okay? There's no extrinsic value to either of those options, right? They're 100 delta. They're just like stock. So that thing should be trading $10. You may see market makers or whomever trading that spread back and forth for $10, or maybe the 150, 160, or whatever it is. And then what they look for, and this is what we used to do, what they look for is someone to forget to exercise those options that are really so far deep in the money that should be exercised to get the dividend. So if I bought this call spread, for instance, where I bought the 140 and I sold the 150, okay, and we did that for $10, which is the proper amount. If I was long, if I owned the 140s, I'm absolutely going to exercise those to collect my $1.66 dividend. Now, the person, exactly, Rodney, the person in the world on the other end of the trade that owns these 150s, what if they forget to exercise those calls? If they forget to exercise those calls, then I win. I get the benefit of not having to pay that dividend and of the value of this call. What's going to happen to the value of my short 150 call when the stock goes ex-dividend the next morning? It's going to be lower by $1.66. That's a huge win. Huge win. So you will see in stocks that pay big dividends, typically you will see big call spreads being traded the day before the stock goes ex-dividend in the hopes, as Rodney just said, someone's not doing their homework. Someone doesn't exercise those long calls. And you escape, it's what we used to call it, you escape on your dividend play. You will see that happen. I will, again, we'll keep a record of this, and in a couple weeks, November 7th, we're going to look for that option activity. And I would bet that we're going to see a lot of deep in the money call spreads. How do you exercise, John? You can do it automatically on your platform. You go to your position and you just say exercise, or you can always call up your brokerage firm to do it as well. Remember, American style options, which is just about most options that we trade, they can be exercised early. European style options cannot be exercised early, like VIX, SPX, okay, a bunch of other indices out there, they cannot be exercised early. Okay, Does that make sense to everybody? It's exactly what we talked about, or exactly what we used to do. You'd look to escape paying the dividend. Now, I'm going to play a little song here just to close us up. Anybody know what this song is? It is the Pina Colada song, but the real name to this song is Escape. So that's why I'm playing it. But a Pina Colada wouldn't be so bad right now, I gotta be honest with you. All right, enough of the Pina Colada song. We're gonna wrap this up here, guys. Really appreciate everybody being here. All right, let's get to the wheel here, everybody. Let me get that put up on the board here. And this conversation today, guys, this was definitely a little bit more detailed because of all the Greeks that we talk about, delta, vega, theta, gamma, whatever it is, and all of the factors that go into option pricing. Dividends and interest rates are kind of the ones that get left behind. Okay? You gotta know about it. If you have any follow-up questions, at all, let me know. Okay? And let's get this guy into the screen here. And since I am, I'm just in this festive mood playing music. Let's get also here a little bit of a drum roll. I don't feel like pounding on my desk today. All right, so 1, 2, 3, let's get a drum roll. And there we go. The wheel has spun, and it is Barry Wilbur. Barry Wilbur today. Prosper Swag at prospertrading.com. Barry, shoot me an email, sir. Give me your mailing address and the size swag that you want. All right? And please, guys, I'm asking you, smash that like button. Okay? It really, really helps us out. Smash that like button. Tell people about the live stream. There's always some really good info. All right. Zora, I don't think he's going to mind whether you call him Barry or Strawberry. I think it's all good. All right, everybody. Thank you for your time today. Especially thank you for staying on a little bit longer today. All right. Really appreciate all of you. Let's see, what is the market doing here now? Yeah, we're kind of on our lows of the day here. We're down 70 points in the S&Ps. Okay, and let's see if VIX is starting to pick up, because earlier this morning it wasn't. It is up about $1.50 right now. Let's take a quick look before we leave at the VIX futures curve. CBOE VIX quotes. Let's get that. Come on, why aren't you coming up now? That's not good. That's not good. I want to show everybody what the futures curve is looking like right now, and I can't get it. Hang on. What is going on here? This is crazy. Okay, give me one more second here, guys. Wow, now I'm a little flustered here. There we go. Finally. Maybe. Oh my. I think, you know what? I actually think right now the VIX or the CBOE website is down. It actually is. I don't know what's going on. CBOE website is down to get futures quotes for the VIX right now. So we'll have to do that another time. We'll have to look tomorrow, guys. All right. Have a great, great rest of the day, everybody. Appreciate all of you. Take care, everybody.